Hello, my dear future chartered accountants. I hope my voice is audible and the PPT is visible. Can you please confirm it once? Is the voice audible and the PPT visible? Okay. Slight echo is there. I hope, but it's manageable. Yes. Okay. Very good. Just 1 second. Okay. So, good evening once more. So we are doing the, we finished with few standards. Now it's the time to enter into the prohibited area, I would say, and that is consolidation. In old syllabus, I was telling earlier, you had a choice. Some people, what they do, they go for either amalgamation or consolidation. People used to say, I will not do consolidation, they read for choice. That is not available here. It is a must. In this consolidation, all the things put together, I almost have 100 plus problems. Of course, we will not be doing everything. Many of them will be homework as well, but we should do so many problems that you must be comfortable in this chapter. Doing difficult chapter has got 2-3 advantages like consolidation. That is, when you do chapter like consolidation, you get a confidence in life. If I can do consolidation, I can do everything in life. And one more important thing is in examination, if difficult question comes and you don't solve it, you don't feel bad. You always feel when easy question comes and you are not able to do it. So that is one reason you have to do whether is the consolidation you like it or not. But not to praise myself, I'm just telling you the fact. The way we learn consolidation in our classes, the method we try, many people have told me that they could clear financial reporting because of this technique we follow. So that confidence we can take it from my side. The process we are going to follow, the method we are going to follow, the number of problems we are going to solve is definitely sufficient for exams and you must do it. That's a confidence I have to give you. Okay. So let's start from the basics. That is, what is the objective of consolidation? Let me take you through some basics now. What is the objective of consolidation? Okay. Now, any idea what do you think is the main objective of going through this process? I know your mindset might be telling to uh, torture students, to reduce the A pass percentage, and so on. Okay. The main objective. Let me help you with the help of an example. There is one company called as Reliance Industries. Reliance Industries. Okay. Now tell me any idea uh, what is the sector of Reliance Industries, main sector which listed company Reliance Industries belongs to? Any idea? What do you think? Which sector? It is not the telecommunication. Telecommunication came recently. Do you think Mukesh Ambani was recently into the stock market? I mean, recently into this business? The main sector of Reliance for a long period of time is petrol or petrochemicals or whatever you say, oil industry, oil and petrol, oil. That is the main sector of Reliance Industries. And you know, most popular product of Reliance that you are fond of now is Reliance Jio. Now, do you think Reliance Jio is a product under Reliance Industries, under the entity Reliance Industries? It is not. It is under a company called as Reliance Infocom. Now they've changed, they did some merger, demerger and all, but let's say that's Reliance Infocom Private Limited. They've changed the name, they have done the demerger, merger, so they are going for IPO also. Let's keep that aside. Now, Reliance Industry is a different entity, Reliance Infocom is a different entity under the Reliance Jio comes. Now, then if Reliance plan changes, they started charging, let's say 149 rupee pack, they'll make it as a 150 rupee pack. If they make it like that, do you think Reliance Industries share price will change? Reliance Jio is making change to its plans. It will come under the company called as Reliance Infocom. But Reliance Industry is a listed company. Do you think their share price will change? In stock market, is there any connection? Definitely yes. There is going to be a change. There is a change. Why? Why there is an impact? Because Reliance Industry is the holding company of this. In fact, 100% holding company. Now they are diluted, and they have in their balance sheet something called as investments. Now, when Reliance Jio changes its plan, their profitability changes. Their profitability means the investment value of Reliance Industry will change. When investment value of Reliance Industry change, their balance sheet value, their share price will also undergo a change. Now, being a shareholder of Reliance Industries listed company entity, do you think it is sufficient? I am informed about the operations of Reliance Industries, the main holding company. Not sufficient. We own Reliance Industries as a shareholder, and Reliance Industries has a share in Reliance Infocom, which means I am impacted, I am influenced by the movement of Reliance Jio, I mean Reliance Infocom. Just because it's a private company, am I not affected? I am. So, as a shareholder, stakeholder, users of accounts, it is not sufficient to understand about the company. We have to understand about the overall position of the group. Balance sheet you prepare only for a entity, P&L also. But we want to understand what is the overall position of the group. In various cases, you can argue this. For example, a company is giving a loan, a bank is giving a loan to a company. Now, when that company is a member of the Reliance Group, a company is an independent company, don't you think you're going to make a difference of opinion, a difference in treatment? Because when you're backed up by your Reliance Group, even though it's loss-making company, you would like to give loan because they have got strong promoters. It's part of a strong group. Various examples we can see. The objective is the example I give you, Reliance Industries, Reliance Infocom. It is not just about understanding the independent entity, it's about understanding overall position of the group. So in a way, we can say we are lifting the corporate wheel. We are removing the impact of separate entities and we are all bringing them together. So as of now, only holding company, subsidiary company will come together. Other things we'll discuss as we go further. Okay. The same thing applies in many other cases. Don't take me personally, just for example purpose. Even when you want to get married, your parents, especially in Indian system, arranged marriage, do you think they look at only the person? No, they look at the friends group, they look at the family. How many persons are there in family? Is it a joint family? Do that person have brother, sister? Where are they? Because suppose property comes, if it is for single person, all property comes to him, liability also comes. If many persons are there, brother, sister, the property will get shared. Maybe you take that into consideration. I'm not telling you will, but you may. You should be informed about all the data points. That's what exactly is the objective of consolidation. Is to give you the overview of the group and not just individual entities. Okay. Hope you got the overall, the purpose for which the consolidation is being prepared. So you know the main objective of preparing balance sheet to know the financial position of a company, and consolidate balance sheet is to know the financial position of the group. Okay. What are the standards which are applicable here? That's one thing we have to be very, very clear, because many people don't know difference between Ind AS 103, Ind AS 110. When business combination comes, when consolidation comes, in accounting standards, it's very, very straightforward. AS 14, business amalgamation, and AS 21, consolidation. Here, there's slightly different, and that is making a lot of change. Okay. First, let me give you an overview of it. So, what are the standards? Ind AS 110. I told you Ind AS 110 means IFRS 10. Consolidated financial statements. Ind AS 111. Joint arrangements. Ind AS 112. Disclosure. This is not much important. Ind AS 28. These investments in associates and joint venture. Ind AS 27. Separate financial statements. So many standards are applicable. Let me tell you which standards are applicable under which cases. Then we look at the content of it. If you have a full control over entity, sir, what do you mean by the word control? It's a bomb. The word control can explode. It has so much interpretation. It's not so easy as we have in accounting standards. Accounting standards say simple. You have more than majority, or you have more than majority in the board of directors or in shareholding. You control the company. Accounting standards rule based. Ind AS is not rule based. Ind AS principle based. So how do you know whether there is control or not? That itself might take a class for us. At least we have to do quite a few problems based on that. But assume you know it. If you have a full control does not mean you have 100% holding. Majority is also sufficient. Many other points also sufficient. Okay. If you have a full control over the entity, then you are going to consolidate under Ind AS 110. And you disclose under Ind AS 112. If you don't have a full control, then you check whether do you have a joint control. Joint control means sponsor. You with another person together control a company. Husband and wife together control a child. Joint control, joint entity. So that entity is not controlled by one person. It is together. Two people put together control the company. Joint control. If yes, then you classify what is the nature of joint control or joint control entity. And you provide disclosure under Ind AS 112. What are the nature you can provide? It can be two kinds. Either it is joint operation, in which case you account for assets, liability, revenue, expenses separately, or it is a joint venture. Then you are going to account it an equity method under Ind AS 28. You will not be able to understand this now. As of now, just keep it in mind. In joint control, there are two classifications with two accounting treatment. That much you remember sufficient. We'll understand when we go to that Ind AS 111. We'll understand in detail. Now, if you don't have a joint control over entity, then you check, do you have a significant influence? Significant influence means you have an impact. You don't have control, no joint control, but my voting is definitely going to be considered. Even 1% also will consider, 20% also will be considered. But don't you think, as compared to 1% with 25%, 25% is having impact? A 50-60% will have a control, but 20-30% will have a good amount of impact in decision making of a company. When a person tells with 25% voting share, company cannot reject it. He is also important shareholder, but he's not a majority person. But his words are considered. So if you have a significant influence, then you will be accounting under equity method in the years 28. If not, you disclose. If you don't have significant influence, then your investment will be accounted under an investments. In the sense, I am having one share of Reliance, I am having 100 shares of Infosys. I don't have full control, I don't have joint control. 100 shares out of 1 lakh shares, who will ask you? You don't have significant influence. I'm a mere shareholder, I'm a mere investor. So you account it under Ind AS 109, that is financial instrument, like an investment in shares of a company. Okay. I hope you got this one. Is this part of your material? I don't think you have to take it down. I hope it is part of your material. Yes. So nothing to write down. Any doubts up to this stage? Consolidation is a very tricky chapter, but if you learn it, you enjoy it. Because it's interesting, also because others will struggle. That's one joy where others are struggling and you are able to solve. And it will be painful if others are able to solve and you are not able to solve. Anyway, so consolidation, make sure you understand under every step. Any doubt under any stage, get it clarified at that point in time. Don't keep it till the end. I'm sure you will not remember it because so much is there. Get it clarified as and when it comes. Done? Any doubts? I hope I can go further. Very good. There's one more important area that you have to understand. There's a lot of confusion between when Ind AS 102 applies, when 103 applies, and when Ind AS 110 applies, when business combination, when consolidation. I'll just quickly tell you that. Okay. Please take a look at this chart. Ind AS 103 applies whenever there is a business combination. What is business combination? You acquire a business. You acquire a business. If acquired entity is liquidated, Ind AS 110 don't apply. If acquiring entity is continued, Ind AS 110 applies. Okay, you may not be able to understand this standard. I'll give an example. Please listen to these points very carefully because many people are confused which standard to apply. That itself they don't know. Forget about the contents and the issues to be addressed. Okay, so take a look at this one. Normal business combination. Okay, let's say business combination is like amalgamation. A company acquires B company. Now, which entity will continue after acquisition? This is your typical business amalgamation. Typical amalgamation. So which entity will continue? Please tell me. A Limited acquires B Limited. Which entity will be continued? B Limited is closed, right? B Limited is closed. So only A will continue. So amalgamation under AS 14 will apply. I mean, I'm comparing it. And business combination also applies under Ind AS 103. This is straightforward. This is not at all a confusion. This is an important point. Please observe. A acquires 80% of B, means 20% is held by others people. A has acquired 80% of B. Do you think if it was a situation under accounting standard, will AS 14 applies? What do you think? Will AS 14 applies? A Limited acquired 80% of B Limited. AS 14 will not acquire. Where is the business? Where is the amalgamation here? A Limited got 80% of B Limited. A Limited is also there. B Limited is also there. There is no combination. There is no amalgamation happened. So AS 14 don't apply. But this is interesting. Ind AS 103 applies. So why Ind AS 103 applies? A Limited was doing its business. Now it acquired 80% of B Limited, which means A Limited now can control B Limited's operations. So indirectly, A Limited is doing its business as well as A Limited is controlling the operations of B. So there is a business combination. So when we say Ind AS 103 business combination, it need not be just a amalgamation. Even if you get a control, Ind AS 103 applies. That is a interesting situation. Okay, so on the date of acquisition, let me give you chart. This chart might not be there in material. You can add it. On acquisition, so Ind AS 103 applies. For both situation applies. What is on acquisition means? You acquire 80% of the company or you acquire a company and it's liquidated. In both situations, Ind AS 103 applies. Ind AS 103 applies on the first balance sheet. On the first balance sheet. Please write down parallelly. After amalgamation or acquisition of shares. After amalgamation or acquisition of shares. Both cases. Ind AS 103 applies on the first balance sheet. Immediate balance sheet after holding company acquires the shares or you take over a company and other company is liquidated. In both the cases, Ind AS 103 applies. Now, two things can happen as we just discussed. It's a case of amalgamation where companies, other company, acquired companies liquidated. Acquired company is liquidated. Transferor company is liquidated. If acquired company is liquidated, then what do? Let's say that, for example, only one company will be existing, like A Limited acquired B Limited, B Limited no longer there. So the acquirer continues to prepare regular books of accounts, continues to prepare individual balance sheets. Individual balance sheets. The acquirer is one company now. That's only one company continued. In our example, A Limited continue to prepare. You may not be able to understand the handwriting. Acquirer continues to prepare individual balance sheet and P&L account. Individual financial statement. Individual financial statement. Let me say individual financial statements. Okay, this is interesting one. Acquired company is not liquidated. Acquired company is not liquidated. Acquired company is not liquidated. Now, here you tell me, that is, what do you mean by acquired company is not liquidated? It's a case of holding company, subsidiary company. That is the date on which the holding company also there, subsidiary company also there, and both will continue. Now here you please tell me, if A Limited acquired 80% shares of B Limited, how many financial statements will be prepared? How many sets of financial statements need to be prepared? Think carefully. Only one. How can you say? There are two separate companies. A Limited acquires 80% of B Limited. Do you think A Limited is sufficient to prepare balance sheet? A Limited, B Limited are separate entities. A Limited also is there. B Limited also continues. Acquired company is not liquidated. A acquires 80% of B Limited. That means 80% shareholder is A Limited, somebody else is 20%. Company is not closed. A Limited continues, B Limited also continues. Total financial statements are not one, not two, but three financial statements. You know what are those three statements? By the acquirer. Let's say holding company. Holding company prepares one financial statement. Subsidiary company prepares its financial statements, and along with that, holding has to prepare one more. So holding company will prepare two financial statements. Like Reliance will prepare its own balance sheet also, and consolidate financial statements. Both must be prepared. So when you look at the Reliance annual report, Reliance Industries, you will have Reliance Industries individual balance sheet as well as Reliance Industries consolidated balance sheet. Two balance sheet will be given to holding company. Subsidiary company prepares only its individual financial statements. So subsidiary company prepare its individual financial statement. FS means financial statements. Now, holding company individual financial statements, we don't call that as individual financial statements, we call that by a name. Holding company prepares two balance sheets. One is individual balance sheets, individual financial statements, another is consolidated. Now, regularly we say balance sheet. When you say balance sheet of a company, you understand that is individual company. But holding company has two balance sheets. It has to give a name. For consolidated financial statements, the name is consolidated. So they give the word consolidated balance sheet. But we have to give a name for their individual financial statements also. You can't say balance sheet of Reliance. You get confused. Oh, is it consolidated or individual? We have to give a name. So we don't call it as individual financial statements. We call it as separate financial statements. In practically we say standalone, but in the legal terms, as per Ind AS, we use the word separate financial statements, and they prepare consolidated financial statements. And to prepare consolidated financial statements, what you have to apply is Ind AS 110. There, Ind AS 110 gives you what are all the principles to be followed, and separate fund statements, the individual fund statements is there, and that will be done as per Ind AS 27. Individual fund statements will be done as per by this subsidiary company as per regular books of accounts, like any other company do. Subsidiary company also prepare its books of accounts. But holding company, in addition to regular balance sheet, they have, while preparing separate fund statements, they have to have investment in shares. They follow everything, but only for one item, investments, they follow, they have to call standalone, but here the specific name is separate financial statements. Now, basic question I've explained. Let's see if you can answer this. When I discuss about consolidation, which standard should be discussed? Ind AS 103 or Ind AS 110? When I discuss about consolidation, when I talk about consolidated balance sheet, which standard applies? Ind AS 110 applies, correct. But initial balance sheet as per Ind AS 103, right? So both standard principles to be kept in mind. Please write a note. Please write a note. Note. When holding subsidiary relationship is established, when holding subsidiary relationship is established, when holding subsidiary relationship is established, a consolidated balance sheet is prepared, is established, then a consolidated balance sheet is prepared immediately. A consolidated balance sheet is prepared immediately under Ind AS 103 principles. Under Ind AS 103 principles. Under Ind AS 103 principles. And subsequently at that, and subsequently principles of Ind AS 110 is applied, and subsequently principles of Ind AS 110 is applied. Principles of Ind AS 110 is applied. So which means, to summarize all these things for our discussion now, consolidation. Okay, consolidation we're discussing now. Initial recognition of special item we recognize. Initial recognition of consolidated balance sheet is done under Ind AS 103. Subsequent recognition like we are going to recognize something called as goodwill, something called as non-controlling interest, all these items are there. So those things are, initially recognized under Ind AS 103, subsequently when we prepare at the end of every year financial statements, that is under Ind AS 110. Hope you got the absolute clarity. So initially at the starting point in days 103 and subsequently at the end of every year we apply in days 110. So in days 103 is a one time effort. It is one time only on the date of acquisition. So in days 103 applies only on the date of acquisition. On one time this is only on the date of acquisition. Whereas subsequent recognition, that is index 103, applies at the end of every year, or if you prepare interim also, that's fine, at the end of every year. Okay, any doubts till here regarding application of which standard under which situation? We have not even gone for the status on what are the contents of standard, in which situation which standard will apply. I hope you got it. Any doubts? Please confirm. Okay, very good. Okay, now we'll come to one by one standard. First standard is Ind AS 27. That's what we discussed about separate financial statements. Now, who will prepare separate financial statements? Don't tell me everybody will prepare. When everybody prepares, we just say balance sheet. Or for our reference, let's say I'll call it as individual financial statements. Individual financial statements. When entity is having a subsidiary or associate or a joint venture, in that case you have to prepare your individual financial statements as well as your consolidated financial statements. We need a way to differentiate, so we call it as separate financial statements. In AS 27, separate financial statements are prepared by entity, let's say holding company, who have either subsidiary or associate or joint venture or any or all of the above. Okay. Companies having subsidiary, that's what is entities preparing the consolidated financial statements. In separate financial statements, how do you measure investment in subsidiary, investment in associates is given by Ind AS 27. Ind AS 27 is about a balance sheet of a company who prepares consolidated statements. We are not talking about that. They prepare separate financial statements, and in the separate financial statements, they will have investment in associate, investment in joint venture. That how do we value it? You have two choices: Ind AS 27 at cost or Ind AS 109, which is typically at fair value. Why this standard was required? Let me take you through little bit of Ind AS 109 financial instruments. Financial instruments. When you invest in bonds, it is a financial instrument. In general, I'm talking about it. Investment in shares is a financial instrument. Investment in shares of Reliance, investment in shares of TCS, investment in shares of SpiceJet. Normal person also invest, company also invest. Now, investments, how it is valued? If you remember AS 13, current investment, long-term investments. Current investments, cost or market value, whichever is less, and long-term investment are classified as cost less unless there is permanent diminution. Such concept in AS 13 is not there in Ind AS. Financial instruments, Ind AS 109 talks about these things like investment. It gives you two categories. Only two categories. Investments can never be at cost. Investments under Ind AS can never be. Investment in shares, bonds is different matter. I'm talking about investments in equity shares. Investment in equity shares can never be at cost because the shares of the company always will change, depends on the performance of the company, depends on valuation of the company. So financial instruments as per Ind AS 109 says investment should be carried at fair value through P&L account or fair value through OCI. What is those two categories? We discuss later. So either fair value through P&L account or fair value through OCI. So either case, you have to recognize investment in your balance sheet only at fair value basis. But what happens for these consolidated statements? These investments will be taken away and together you prepare a consolidated balance sheet. So when you follow the consolidation process, the fair value will automatically be accounted. How? We'll understand as we go further. So the standard says, anyway, you prepare one consolidated financial statements, all the fair value process would have been taken care there. So in your separate financial statements, don't worry about the fair value, you can continue as cost. In general, Ind AS does not permit investment in shares at cost. One exception, Ind AS 27, investment in shares of subsidiary, associate, joint venture entity, if they want, they can continue to recognize it at cost basis. You can do under cost basis or you can do it under Ind AS 109 fair value basis. No other investments can be shown at cost. This is the only exception. Why? What is the logic? I told you, you prepare consolidated financial statements. In CFS, in consolidated statements, the investments are replaced by the assets and liabilities of the respective subsidiary companies. Okay, this is the application of Ind AS 27. I hope the concept is clear. If you have doubts, you can ask. Okay, I believe no questions are coming. Now, what and all other points which are covered under Ind AS 27? The entity shall apply the same accounting for each category of investments. Now, what is the category definition? What do you mean by the word category? Not given in the standard. For our convenience, we interpret category means joint venture is one category, associate is one category, a subsidiary is one category. That is our general interpretation. You can also interpret like subsidiary relating to this sectors is one category, subsidiary relating to this category. You can say that in different sector. That depends on your definition. That is not given under the standard. Standard says for a category, your accounting policy must be consistent. What do you mean by that? For joint venture, I can say I'll follow fair value method, do it. For associate, I'll follow cost method, do it. For subsidiary investments, I'll follow fair value method, do it. But for a subsidiary, don't follow different method, because generally we say subsidiary belongs to same category. Joint venture belongs to same category. Associate belongs to same category in general. But definition of category is not there in the standard, so you can make a judgment as long as it results in the true and reliable information. Investment shall be carried at cost subject to impairment. This is similar to AS 13. Carried at cost unless the value of company going down. Value of company going up, no problem. An entity may be required to classify its investment in subsidiary, joint venture, associates, or include in disposal group in accordance with Ind AS 105. Which means Ind AS 105 says if you are planning to sell a fixed asset, Be tangible, intangible. Don't value it under Ind AS 60. We have a separate standards, which means any assets held for sale, because those assets are not going to be used. Those assets are there meant for sale purpose. That has to be clearly shown in the financial statements. And how to value those? Ind AS 105 also. Ind AS 105 covers it. So if you are planning to sell a subsidiary, just like any fixed asset planning to sell, intangible assets planning to sell, even investment in subsidiary, if you are planning to sell, you may have to classify it under Ind AS 105 and those valuations apply. Dividend shall be recognized when the right to receive is established. This is a killer adjustment. Simple sentence, but a killer. Do you remember in AS 13, there is concept of pre-acquisition dividend? When you receive a dividend for the period, you are not a shareholder. You become a shareholder on 30th of July and 31st of July you receive dividend for the year previous year when you are not a shareholder. It used to be called as pre-acquisition dividend. Do you remember what is the treatment of pre-acquisition dividend in as per AS 13? Where will you transfer it? Pre-acquisition dividend received by an investor. It is transferred to which account? It would have been transferred to investment account as a recovery of cost and not as a P&L account income, correct? That concept is not there under Ind AS 27. So no concept of pre-acquisition dividend. In the separate financial statements by the holding company, they will transfer the dividend received, transfer to P&L. Right to receive established as per AS 9 only. That is when you receive the amount or when you receive the coupon. Nowadays everything is online. You receive the amount. So here you can mention no distinction between, no distinction, no separation, no differentiation, no distinction between, no distinction between pre-acquisition dividend and post-acquisition dividend. Pre-acquisition dividend and post-acquisition dividend. No differentiation between pre-acquisition dividend and post-acquisition dividend. Okay, hope you got this one. Okay. Then difference between accounting standard and Ind AS, there is no difference because accounting standards not there itself. So all these preparation, treatment of different things, disclosure requirements, nothing is there in accounting standard because no corresponding things. So all the contents of Ind AS 27 are the differences. So it does not say you have to follow Ind AS 27. In the sense, you can follow the regular investments under Ind AS 109 also. And yeah, if classified held for sale 105, the summary of this standard only given here in the differential column. Very simple, because accounting standards don't have this separate financial statement concept. Okay. Any doubts in the Ind AS 27 category? Oh, I believe no other questions. Held for sale. If you are having an investment in subsidiary and you are planning to sell, if you are having the intention of selling immediately, then the Ind AS 105 applies, not Ind AS 27. That's what it is. If classified as held for sale, Ind AS 105 applies. The valuation mechanism as covered in Ind AS 105 applies. However, it's fine. Should holding company also classify as held for sale? We are discussing in the books of holding company only. Holding company will have investment in subsidiary company. How to value that investment is the discussion of Ind AS 27. If those subsidiaries are held for sale, you are planning to sell the subsidiary, you will be applying Ind AS 105. Okay, let's go further. Okay. A company, AB Limited, holds investments in subsidiaries and associates. In separate financial statements, AB Limited wants to elect its investment in subsidiaries at cost and investment in associates as financial assets through fair value through profit or loss in accordance with Ind AS 109 financial instruments. Whether AB Limited can carry investment in subsidiaries at cost and investment in associates in accordance with Ind AS 109 financial statements, in separate financial statements. So what does Ind AS 27 tell? Ind AS 27 says a company can adopt different valuations for different categories. The category definition is not given. Definition of category not provided in standard. Hence, it is reasonable to assume, it is reasonable to assume associates and subsidiaries are different categories. And what are these reasons? Because associates means you have only significant influence, whereas subsidiaries means you will have full control. So I want to give a different valuation. Accepted. Hence, measuring investments in subsidiaries at cost and investments in associates at fair value is in line with Ind AS 27. Measuring investment in subsidiaries at cost and measuring investments in associate at fair value is in line with Ind AS 27. Ind AS 27. Okay, hope you have taken down. Very simple problem. Let's go further. Coming to consolidated financial statements, that is Ind AS 110 now. Now, when does Ind AS 103 apply? Subsequently, 110 comes if there is a holding subsidiary relation. First important point is the application of control. Just give me 1 minute. Okay. So who prepares consolidate financial statements? One entity who controls the other entity. Should we consider potential shares? I'll come to it slightly later. In general, consider, I'll come to it later. Why should we prepare consolidated statements? Statute requirements, Companies Act says it, and as per Companies Act, even some sale features should be there. Even listing agreements, Clause 49, listing agreements, SCRA, stock exchanges, because of that also will apply. Okay, that is statute requirements. Companies Act says it, AS 21 says it, that you don't worry much. What does India says? That will focus. You should have control. Control is a beautiful term. They say three elements to be satisfied. As per AS 21, if you say, I am controlling another company, holding subsidiary company, two or maybe three major two conditions, one of them should be satisfied. One is majority holding, 50 or 51%. If you have more than majority holdings, you control another company. Uh, or you control the board of directors. You control more than half of the board of directors of other company, because you control more than half means majority you control, and board of directors are the ones who do the business operations, so they control the company. You control board of directors control the company, so you control the company. That was as per AS 21. Simple, straightforward, matter closed. Ind AS, substance over form, principle based standards, we can't say like that. Control. Now, let me give you the example of politics. You may be able to understand it better. To become a prime minister, do you think in India, I'm asking, a party must have majority? Do you think a party without majority, a person from that party can also become prime minister and control the country? Definitely, yes. Coalition government we are seeing in so many states. Party who is not having majority, but the highest in the seats. Number one, they are not forming governments. All these small people put together, they join and they make the mockery of democracy. Anyway, but the constitution allows it. We can't say anything. But I don't know whether you know it or not. A person from my state, that is Karnataka, his name is H.D. Deve Gowda, our past prime minister. You have any idea how many seats he had won when he became the prime minister for about a year or so? He had hardly some 15-20 seats, I think, maybe less than that, but he ruled the country for so many months, more than a year. His son is also into same category, H.D. Swami. He never got majority, but he became the chief minister, and he is thinking of becoming again. But anyway, so the point is to control majority is not a necessity. So India says one company should controlling another company means, sir, can I look at shareholding? You can. Can I look at board of directors? You can. But what should I look at ultimately? Tell me. Do you have a control? But give me some guidelines at least. Okay, India is giving you guidelines. To be having the control, the word control, I told you on day one itself, the control, it's going to change your life. You will lose control of your life. The standard gives you three elements of a control. So it's not a rule based, it's a principle based. What are the three principles? Power over investee, Right to variable returns, ability to use its power. Simple example I'll take. You have 60% of a company's shares. Power over investee. Do you have the power? Yes, 60% means you definitely have the power. You can decide whether to accept or to reject. Power over investee, first point. Second, right to variable returns. You are a owner. You can't say I want a fixed income. When companies making more profits, you should make more profits. When company is having less profits, you will have less profits. Your income should be in tandem with company's income, variable in nature. One, power over investee. I have the power. I can determine what they should do. When I make a judgment, that is, this person should be appointed as auditor. Yes, that person will be appointed. You have the majority. Power over investee. Right to variable returns. That is the true nature of a owner. Fixed income means you are not a owner, you are a lender. You don't control. Why will you control with your fixed income? Only when you have intention of making more profits, you start controlling other company. And more importantly, ability to use its power. Restrictions should not be there. Conditions should not be there. Ability to use the power in the sense you have 60% holding. Yeah, very good. What and all you can do? You can decide whom to appoint as cleaners for the company. You can decide whom to appoint as auditor of the company. Very good. You can do all these things. What you cannot do? You can't decide who will become the managing director of a company. You can't decide which product to produce by a company. You can't decide how many branches should the company should own. Who will decide all these things? Board of directors will decide with 40% people. Where will all these things be there? It might be in the articles, it might be in the memorandum, it might be in the shareholders agreement. In the sense, having 60% is normally you have the control, but not necessarily. If you have restrictions, you don't have control. You have 60% ownership in a company in Pakistan. You can't control. It is subject to lot of political impact and restrictions. You don't have control. Just because your majority is not the necessity. So we look at various situations. We will look at theory questions under which there is control or not. We are going to discuss. Mere majority is not a necessity to become a control. With majority, you can say there is control or no control. Without majority, you can say there is control, no control. But for solving full-fledged problems, for solving full-fledged consolidated balance sheet problems, there 60%, 50% more than majority will take it. Then you don't have to do. With 40% can I control? With 60% what is the guarantee? You need not control, not required. But while doing problems of theory, which they can ask in exam also, in the study material also a lot of questions are there, and I include all of them. These three elements. I repeat these three elements. Power over investee. Power may be derived from shares. Power may be derived from agreements. Power may be derived from past experience. Reliance, Mukesh Ambani, does he have 80%, 90% shares? He hardly has some percentage. But he has the shareholding along with his wife and children and many more people. Then also it will not be added up to 50%. Various things we have to look at, power or investee. You have 40%. Can you control the company? Do you have the majority? You don't have the majority. But if you look at the history of the AGM, remaining 60% is held with so many thousands of people who never come to AGM. You see, so many investors, even like me, have invested. I manage portfolio. I never vote. I never go to the AGM. So 60% is spread across many people. So effectively in AGM who vote is only, let's say, 60%. So 40 out of 60, 40 is under 1%. Remaining 20 small people who cannot have much of impact. So even though with 40%, I derive the power. So power may be from shares, maybe from agreements, or maybe from the practice. Looking at the historical data. Right to variable returns. You should not have a fixed income. That is not the nature of an owner. You should be a controller, means you should be an owner. And ability to use the power means there should not be any restrictions. There should not be any restrictions. Power over investee. Why they use the word investee is because, see, only when control is established, a subsidiary company's term is used. Before becoming subsidiary, what do you call? I am putting money, I am investor, I am putting the money on you. What do you call yourself? You are not a subsidiary yet, you are still assessing. We call it as investee. Investor, invest. Okay. And then there are detailed guidelines of assessment of control as per the study material are included. First step. What is the purpose of the investee? Why are you investing in the new company? Is it to extend the business or not? If your intention is to invest, your intention is not to operate the company, your intention is to invest. A lot of venture capitalists will do it. Private equity firms, their objective is funding the operations. They don't sit and operate your business. They say, you want money, I'll give me money. I'll give you money. You give me the share of profits. I'm ready to take the risk. I will not come in day-to-day operations. So the purpose of investment, the investee is not to extend the business. Pure investment control will not be there. As an exception also it will come later, I'll tell you. What is the design of the investee? Legal form is going to play a role. Legally, is it a separate entity? Is it just a branch in a foreign country maybe? So what is the legal form that is going to play a role? These are the points to be considered. Then what are the relevant activities of the investee that significantly affects return? It's important. What is the main purpose we are discussing? Control. Right? Control. Now control means what? Controlling what? There is a common thing. Again, only for example purpose I tell, don't take it personally. In a family, who controls the family? The husband or the wife. Again, example purpose, please don't take it personally. Normal, one joke goes around like this. A husband says, majority decisions I will take. Small minority decisions wife will take. What are majority decisions? Who should become Prime Minister? What should be the discussion topic in Arnab Goswami's debate today? What should Narendra Modi should have been done? What should our chief minister should have been done? All these big topics I will decide what to be done. Small topics, what to prepare today, where should the money be invested, which school should children be joined. These small things wife will decide. Anyway, just for fun I told, those are the relevant activities for the family, not these big decisions. So when we talk about the company, when I say one person controls the another, controlling what? Controlling how many switchboard to be purchased, whether to purchase AC or cooler, how many AC to be purchased. Insignificant things are not important. Operating and financing activities, who will decide whether to accept a loan or not? Who will decide what should be the operating capacity of a machinery? Who will decide how many employees should be there? Who will decide whether work from home option should be given to employees or not? Mode of operations of business. What should be the selling price? What should be advertising strategy? Marketing decisions, relevant activities. So, are you involved in main significant relevant activities which will affect your returns? Next, how decisions about the relevant activities are made. Now, third and fourth and are mixed. Third point is what are the activities? Fourth point will tell you, are you controlling the activity? Correct? Next, whether the decision is empowered and has the right to take those decisions. Decision maker is a principal or decision maker is an agent. The person is investing. Are you in the nature of a principal or are you in the principal, are you in the nature of an agent? In the sense, you are a manager of a company. You are a manager of a company. You are having 10% shares, variable returns. You also get salary from the company, fixed amount of salary plus some incentive you get. Now, manager is the person who controls all the activities. You decide, yes, definitely you control. You have 50% share or you have 10% shares also. So your decision will make more profit, less profit, and you have got the right to receive those returns. And do you have the power? Yes, manager has the power. Can you use your power to make variable returns? Yes, the manager makes decision about relevant activities. But remember, manager can do all these things, but manager is not the principal. He is the agent of board of directors. He is appointed by shareholders, whatever may be the case. He is just in employment. Just because he has certain percentage does not mean he controls the organization. He is always bound by his employment agreements. He will have certain powers. He cannot go beyond that. So decision maker should be independent principal, not an agent. Mukesh Ambani also has some 5-6%, 10% shares in a company, in the Reliance. Less percentage. He is a managing director also, but he will get a fixed income also, fixed salary also he'll get. But he is definitely empowered to make decisions, to sign agreements. So he will become he is not an employee, he is the controller. In some other company with the same 10% holding and with the managing director position, he may not be a controller. So it depends on facts of the case. So you should be independent in making decisions. You should not be bound by any restrictions, by any agreements. Investor should examine whether it is exposed. Investor should examine whether it is exposed to have variable returns from involvement with investee. In the sense, I am having 60% shares. I don't invest. I don't do daily operations. I can, but I don't go. I don't operate. But if I make some decisions, I make active decisions. In the sense, I have a subsidiary company. They manufacture some inputs for my products. So I go and tell them, I want this design. I want this design. So I control the operations, and their inputs will matter to my operations. So when I make a decision, I have the power, and using the power, I make those decisions, and those decisions will result in variable returns. If the decisions is not going to have any impact on my variability, then I'm not enjoying it as owner. So basically it tells you, when I control, I must have been influenced. My return should fluctuate. I have control, I do changes, it will not affect me. Then what's the point in it? You can't say, I invest in this company, I want minimum 5 lakh. You can't say that. That means you are not the owner. Or you can receive 5 lakh, any excess you get, you should give it to somebody else. So your actions should influence your returns. Power and profits should be connected. That's what this is all about. And that's what the last point is all about, link between the power and variable returns. So again, 6 and 7 points are connected. Sixth point is about you should examine whether it is exposed to a variable return from involvement, and here it's about power and variable return. So point 6 is more about just an involvement, just the presence, does it make difference or not? And point 7 says when you have the power should be linked specifically with variable returns. When you make a decision, the profit should change. Again, you didn't worry too much things about these points, but keep it in mind broadly. When we solve problems, these steps will help us. In the exam, they will not ask you write the steps, but these principles keep it in mind. It will help us while solving problems. Uh, any doubts up to this stage? Quite a few problems need to be solved. Okay. Please take a break of 10 minutes and then come back. We'll continue. Please rejoin in the meeting. I'll restart the system. So please rejoin. Take a 10 minutes break and come back. So while assessing the control, one more issue arises. Should we consider potential shares? You are having convertible debentures, which you have now, but subsequently, as of now, what you have is debentures. But once you convert, in future, it becomes shares. Should you consider those now? As on date, you are just having debentures, but in future, you may become a shareholder. You may become a shareholder with control, more than 50% majority. You may get the control later. So should you get the rights into consideration? Substantive in nature to be exercised when the decision about relevant activities to be made. Factors to be considered as barriers preventing exercise. Requires other agreement. Benefits accrue to the right holder. Protective in nature, protect the interest of the holder without the power over investing. Let me explain you this concept. Okay. Two types of rights are there: substantive in nature, protective in nature. If it is substantive in nature, then it will be considered for assessing control. What are those? You are having now 40% shareholding. When you are having convertible debentures, convertible preference shares, in 6 months from now, you will convert it into shares. You are planning to be exercising the option to convert, and you are going, once that is done, you are going to make a, or you will have the power to make a decision about relevant activities. That is substantive in nature. So you are going to get the control. You are not get the control now. You are going to get the control. Yes, use it now itself. Don't look at the situation only now. Look at the situation, what would happen in future. Not far away. After 10 years and all, don't consider it now. It should be substantive in nature. It should have the impact as if you are going to get the control. Again, these are all principles, no rules. No guidelines, no specific 6 months, 12 months, they don't give. You have to apply judgment. Protective in nature, you have given a loan to company to protect them from misusing it. You say, if you don't make me repayment, or if you default me in 3 installments, I'm going to get 60% of your company. You might get an agreement like this. Or if you don't pay me, then my dues will be converted into shares. These are all protective in nature, protection from misuse of it. Or you might say, I've given the money to your company or given some patents to you. If you misuse it, I'll acquire your company. Protective in nature. So those rights, options, conversions, which has the impact of provision of uh, control are substantive in nature in the near term. Those rights which are protective in nature, where it's not really meant to have any power, it's only for protection purpose, safety purpose, backup purpose. They are not to be considered. Again, it is very difficult to differentiate because we don't have rules, but keeping in mind the objective of it. Is your intention, the objective is to convert the rights into the shares and you get the control, then those things are also to be considered. Exceptions to prepare consolidated financial statement. Now this exception is there only as per Ind AS. Companies Act, you know, the moment you have a subsidiary, you need to provide. But Ind AS is one IFRS, so they provide their own rules. Harmonious conjunction, if I apply Ind AS also, if I apply Companies Act also, then this exception has no meaning because everybody has to prepare the subsidiary account, subsidiary consolidated statements as per the Companies Act. But these exceptions in the exam also, when they ask you in Ind AS, answer only Ind AS. Companies Act, no, you don't have to answer it. Let's understand this exception one by one. Exception 1, 4 conditions to be satisfied. First condition, parent is a intermediary and others don't object. What do you mean by that? Let me give an example. A company controls, or a company is having 60% in B company, and B company is having, let's say, 80% in C. So B is a intermediary company, intermediary, because B is below A and C is below B. So logically speaking, anyway when A prepares B with C, together they prepare. So why should B prepare once more? So what they say is this. If you are an intermediary company and others don't object, others mean what? Remaining people are there, no, 20%. Remaining people in C Limited or the controller, remaining people don't object. The remaining shareholders don't object, then you need not prepare. Of course, you will take approval from remaining people. So intermediary company, you are not, anyway the ultimate company will prepare, so you don't have to prepare it. That's the logic. First condition. Second condition, equity instruments are not traded in public. Oh, you are an intermediary, but it is traded in public. Publicly traded means you can't use exceptions. Public should be always made aware of it. Others objection don't matter here. You have to prepare consolidated statements. Parents intermediary and equities are not publicly traded, not listed, not traded. Not filing with any authority, because this is what the Companies Act I told you. If Companies Act says you have to prepare, you have to prepare. But in some other countries, in some other situations, you may not require to file with any authority the consolidated financial statements. Then you are not required. Ultimate or any intermediary parent prepares CFS. So like this. A prepares A below B, below C, below D, below E. For D, intermediary company, ultimate parent is A. So either A prepares or any other intermediary parent. So either B prepares or C prepares. So basically telling one of you at least should prepare. Then you are exempted. Exception 1, 4 conditions need to be satisfied. Exceptions 2, 2 conditions need to be satisfied. That is, parent is an investment entity, and investment is measured at fair value only. You can't measure at cost. In days 27, you can't measure at cost. You have to measure at fair value. What is investment entity? What is the logic behind this? I was telling earlier, venture capitalists, private equity firms, they invest in hundreds of companies, and they will have shareholding more than 60%, 70% also. Their intention is not to run that business. They don't control the operations. Whatever happens, you get 60% return. Ultimate risk takers. They invest in high growth companies, high risky companies, new age products and services. Their business, the investment entity target is find out various new products and fund them. Angel investors, venture capitalists. Since the intention is not to control the operations, don't consolidate. As long as in your separate financial statements you measure at fair value, sufficient. And the purpose is to invest in funds only. That is like mutual funds, private equity funds, hedge funds. The intention is to invest in that company, not to operate. Like individual people, we purchase the shares of Reliance, we don't control. We just invest. Like that, venture capitalist funds, private equity funds, they invest in private company also, unlisted company also, listed company also. Their intention is to invest and earn income through capital appreciation and not to operating the business. They don't appoint managers, they don't take premise on rent. That is done by different people. Your job as an investment entity is to give money, and though you have majority, you don't involve in any other operations. Then also you are exempted from preparing consolidated statements as per Ind AS. Okay. What is an investment entity? Some more guidelines are there. Let's look at. There are 3 conditions and few characteristics to be called as investment entity. 3 elements are compulsory. Characteristics will help you. They are not compulsory, but they will be indicators. They will help you. What are 3 main elements? Funds from various persons for providing investment management service. That means for this investment entity, funds from various persons. So money comes from various persons. Funds from various persons for providing investment management service. So you get more money and you manage many people. You manage many investments. That's what this one. And the purpose of investment is capital appreciation or investment income or both. Capital appreciation means what? When the company share does well, the share value will increase. Investment income, dividend you might receive regularly. Maybe that was the purpose of the investment. Or both, combination of both. And measurement should be on fair value basis. These are compulsory points. And it should be investment management service, no other thing. It should be for the purpose of managing money of somebody else. What are characteristics? These are not essential but indicators. More than one investment. You invest in multiple companies. More than one investor. Many people come and invest in your company. Investors are not related. That is, more than one investor should be there, and investors should not be related. Otherwise, what happens? One subsidiary, one more subsidiary, they together invest in one company. So they make it look like that. So investors should not be related parties. Issues ownership interest which are redeemable. In the sense, whenever they want, they can exit. That's what will happen in venture capitalists. They invest 60%, 70%, but they will have an exit plan. That I am having one new idea. and I require money. I ask venture capitalists, I need so much of money. They say, I'll give you. What is your exit plan? I'm making so much of products. I'm sure my company will grow and you make good money. Okay. How will we receive our money back? Once the company grows, I will go for listing, initial public offer (IPO). You can sell in the market. You will make your money. Okay, that is good. If things does not work out well, what happens? Don't worry. If it does not happen within 5 6 years, I will give you so much of money, assured income, something like that. Or whatever market value, 80% will be provided. Or whatever the market value at that price, I will buy the shares from you. Exit plan is there. That is what issues ownership interest, which are redeemable in the whenever as per the plan. So if these conditions are satisfied, then investment entity need not prepare consolidated financial statement. I'll just take you through the PDF ones. Give me 1 minute. Okay. Okay. So this is the PDF. Confirm statements, theory, this and all you can go through. Simple meaning explained. Concept of control. This you please pay attention. Power of interest. This is done. Protective interest, substantive interest that I told you. Exception one. This I would like to read once more. The parent is not required to present consolidated statements if it meets all of the following four conditions. Parent is either wholly owned subsidiary. I think this point I am not stressed upon. I am stressing upon it now. The parent is either a wholly owned subsidiary, intermediate parent we are talking about. It should be a wholly owned subsidiary or partially owned subsidiary of another entity, and its owners do not object in presenting consolidated statements. This I should explain once more. Please look into this. A controls 100% in B and B has 80% in C. Intermediary company B is wholly owned subsidiary of A. If A is again other conditions assumed to be satisfied, wholly owned subsidiary are exempted. These people are exempted under Ind AS. Then other condition. What is the other condition? Or partially owned subsidiary of another entity. Partially owned subsidiary means what? A controls 80% in B and B controls let's say 60% in C. B is a intermediary, not a wholly owned but partially owned subsidiary. Partially owned subsidiary. In case of partially owned subsidiary, others are there, no, remaining 20%, because 80% is held by A. Anyway, A will prepare, but remaining 20% people are there. They should say yes. That's what they said. Please read of another entity and its owner. Which owner? The parent entity's owner. The parent and intermediate parent entity is there, no? That owner. These people don't object. And why this condition is not there for the first one? Anyway, wholly owned subsidiary. Where is the question of other owners will come? So that point was not there for wholly owned subsidiary. And if these 2 points are satisfied, others don't object. It's a partially owned subsidiary. Then the intermediate parent company is exempted from preparation of consolidated financial statements. Equity instruments are not traded. Parent has not filed in process of filing any statutory things. Ultimate immediate parent is preparing the consolidated statements for public use. Second exception, that is a parent, if it is an investment entity, parent is an investment entity, obtains funds from one or more investor for the purpose of providing those investors with management services, commits to its investor business purpose to invest only or capital appreciation or both, and measures, evaluates performance substantially, all of it's on fair value basis. Characteristics, it has more than one investment, more than one investor, I told you, okay, then components will look at it later. Okay, so any points you want me to discuss anything on these about control, exceptions to prepare financial statements? Any doubts? Can you please confirm? Other owners case. Other owners should agree. In the second example I gave, A is having 80% in B. B is having 60% in C. The remaining 20% will be held by outsiders in B. The intermediary parent is there. No, their owners, remaining 20% people, they should not object. If they object, then the exemption don't apply. Okay. Any other doubts? Of course, when you do problem, you should get more clarity. Not traded in public. This intermediary company, for example, the same example, company B, if they are listed, they can't use this exemption. The intermediary parent for which you are claiming exemption, they should not be listed. If they are listed, exemption don't apply. You can read through the PDF, my material once more for clarity. Is it done? I hope no other questions. Very good. Okay. Uh, okay. So today we'll stop at this point. Problems we have to take it up. We will take it up tomorrow. We'll stop at this point today. Some issue with the system, so I'm not in a position to continue. So we'll stop at this point today. Tomorrow we'll continue. And for next couple of days, let's have the session live only. Some rain problems are there, so let's not have any confusion. Next 2-3 days, we will have online only. Don't come to the premises. Once it is clear, I will confirm. Then we'll have the classes. We'll have the sessions in the classes. So tomorrow also, let's have only the online class. Okay. So please practice these basic theories. Problems we'll take it up in the next session. So till then, take care. Book is already available. Book you can come to the center and collect it whenever you want. Book is available in the center. Online students, we are posting it. Those who are coming to classes, book is available in the center. You can come anytime and you can collect it. It will be available here. Fine. Yes. So we'll see you tomorrow at same time. Till then, take care. Bye bye.